Please.
Hi, Kunal.
Hi,
Can you
how are
hear me?
you?
Very good. How are you?
All good.
Good to start?
Yep.
Great. Good evening, everyone, and welcome to today's webinar on Carnelian's PMS strategy. So, we are delighted to host a conversation with one of the key minds behind Carnelian investment philosophy and portfolio construction, Mr. Kunal Shah, Principal Officer and member of the fund management team at Carnelian. Now, before I bring Kunal in, let me just set the context by briefly introducing Carnelian Asset Management and Advisors, a firm that has rapidly established itself as one of India's most respected and boutique investment managers. Founded in 2019 by three seasoned investors capital market professionals, Mr. Vikas Khemani, Mr. Manoj Baheti, and Ms. Swati Khemani. Carnelian was built with a clear purpose to create a world-class asset management platform grounded in values, forensic research, and process-driven investing. Some of their highlights, it's a USD 1.6 billion asset under management platform across PMS and EIF, including domestic and gift IFSC offering. It's one of those few 100% founder-owned independent organization, ensuring complete alignment of interests and skin in the game. A team of about 89 investment professionals across 10 different locations with strong capability in research, compliance, risk management, and technology. A reputation for QGAP investing, which is quality growth at a reasonable price, supported by a deeply institutionalized forensic lens called CLEAR, a proprietary framework that evaluates cash flows, liabilities, earnings quality, assets, and governance red flags. Multiple industry recognitions, including awards for theme identification and absolute return. Uh, they have quite a few strategies, but we are concentrating today on their capital compounder, shift, and contra strategies. Carnelian blends a top-down insight with the bottom-up stock selection process. Capital compounder focuses on India's long-term structural opportunity by investing in quality mid-cap businesses with strong moats and sustained earning power. Whereas shift is a strategy which captures decadal transformation in manufacturing, technology, and digitalization, leveraging India's evolving competitive landscape. Contra, on the other hand, is a differentiated approach centered on identifying temporary dislocations, deep value ideas, and businesses which are mispriced due to cycles or sentiments. So each strategy brings something different to the table, but all share a common backbone, a belief in discipline, a belief in research, governance, first investing, and avoiding pitfalls before chasing returns. We have the privilege today to have with us Mr. Kunal Shah, Principal Officer at Carnelian and a co-member of the Fund Management and Investment Committee team. Kunal brings 12 years of professional experience across equity research and portfolio management, a distinguished academic background as a chartered accountant with All India rank, deep hands-on sectoral experience across banking, insurance, consumer, auto, capital goods, chemicals, pharma, giving him a panoramic understanding of India's evolving corporate landscape. And he's been with Carnelian since its inception. So, one of the founding members of Carnelian Asset Management. With that introduction, it is my pleasure to welcome Mr. Kunal Shah. Kunal, thank you for joining us today. Let us begin by understanding how is Carnelian navigating today's markets and what sets your PMS strategies apart in the current environment. Over to you.
Well, thank you, Raj. Thank you for introducing not only me, but also Carnelian and the members. So thank you so much. And good evening, everyone out there. Really pleasure to have you all. So I think, as Raj said, I'll just spend a few minutes as to what differentiates us, and what's also one of the reasons for the alpha that we have all throughout since inception across compounder strategy and shift strategy, which Raj spoke about and introduced briefly. So I think principal differentiator is the way how we kind of look at investment philosophy and framework. So simply we when we speak about this, we look at two aspects. One is growth, and other is risk. Right. So you said that you very well articulated that quality growth companies at reasonable price is the fundamental or genesis of everything that we do. But within that, we further bifurcate and look at things into two aspects. One is what we call as what one is growth, and the other is risk. Within growth, when investing in companies, we simply look at companies into two buckets, what we internally call as magic and compounder. Now, what do we mean by that? Would be the question, right? As to what is magic, right? So, magic essentially means whenever any company which is growing at an accelerated growth rate, right, generally has seen that its P multiple also expands. So we end up making money not only account of profitability growth, but also on account of multiple re-rating that happens. And that's one of our USPs, and that is one of our differentiators. At all point of times, in BSE 500 companies, right, there would be at least around 60 or 70 companies where in good businesses, there would be either change in management, change in promoters, large capex cycle coming on stream, change in some business strategy, or change in industry cycle per se. You know, and in these companies, when we do our due diligence and we believe, that growth will come by, is the time when we kind of, take bet on these companies. To give you a few examples, of multi-baggers which we have had on account of this framework across our schemes are, ICICI Bank, has been like 3x for us. M&M has been like almost 3x for us. Tata Motors post N Chandra coming in has been like 3x for us. Tube Investments, has been like 5x for us. Newgen had been almost 8x for us. Praj has been 10x for us. So this is all on account of this framework, which helps us have non-differentiated, non-consensus ideas to begin with, which then, if investment hypothesis plays out, kind of becomes consensus. So that's one differentiating factor when it comes to looking at growth companies. And then again, when we look at risk, which is the most important parameter, because at the end of the day, we are in the business of risk reward. Again, one unique thing, is we have simplificated how we look at risk. So over here, we classify risk essentially into three buckets. Again, what we internally call as type A, type B, and type C. Type A is nothing but capital loss risk on account of either investing in inferior managements or businesses prone to disruption. Our forensic framework, that is what we call clear and connect, help us avoid and help us avoid it so far in our history, avoiding type A risk completely. That is capital loss risk either on account of governance related issues or disruption prone related issues. Type B internally, what we call is volatility risk. We actually can't do much about it except for having a proper mix of concentration along with diversification. Again, I would want to highlight and stress on what we internally call as type C risk. So this is again very unique to us. What we call this as opportunity cost risk. Essentially, we are saying that we do understand that when our partners have given money to us, it has opportunity cost risk, and at the same point of time, investments have its own biasness that we have, right? So what we are essentially saying is that we don't shy away from evaluating companies outside of our portfolio, and also participate if we believe something outside of the portfolio can do better than what we own. This helps us keep checking on our investment hypothesis of our portfolios, and also something outside of the portfolio which can do better. The best example in the current context is if somebody would have been owning SDFC Bank for the last 5 years, right, would have had completely different experience as to how banks have done in India versus somebody who would have been owning ICICI Bank for the last 5 years. So, this kind of mistakes are generally avoided when we are cognizant of something known as type C risk, which is opportunity cost risk. So, this is the foundation basically and the USP, Raj and colleagues of, about Carnelian, I would say to start with. Coming to the market outlook and how we look at markets in the current context, I'm sure while the indices are near all-time high, but a lot of portfolios probably would not be doing good as indices have been doing presently. So the right approach would be to just let's have a recap of what has happened in the last 1 year to set the context of how next 1 year can look like and how we are positioning our portfolio across different strategies. So actually, the pain all started from March 2024 when the erstwhile governor was just about to go out, right? There was a lot of tightening in the liquidity that was happening. So much so that in March and April 2024, the system had liquidity shortage of almost around 3.5 lakh crore. This was on account of multiple things. Post that we had budget, post that we had elections, which further slowed down a lot of decision making and further liquidity transfusion from the government to the system. Right, a lot of actions post Q2 GDP number, were taken by the government, and the new RBI governor was very gung ho, and accepting that economy needs a push, and that is basically when he started taking a lot of actions again, to kind of improve liquidity in the system. That was followed up by a lot of open market transactions or purchases that were done to infuse liquidity in the system. We have already seen rate cuts. Also, the risk weights, which you all would remember, right, for unsecured loans were tightened, were all kind of, normalized. And in fact, in the Monetary Policy Committee meeting just before the one that happened last week, a lot of other actions also went unnoticed, right? I mean, easing M&A, funding for M&A, a lot of risk weights, etc. Now, on top of that, well, that is on the positive side, right? Coming to the liquidity challenge, then budget, then we are all sure what has happened with the tariffs. So, one after the other, there were a lot of negative events that actually played out in the last 1 year. And at the same time, on the domestic side, government also was taking a lot of positive actions. I talked about all the RBI related actions. At the same point of time, there was income tax rate cuts that happened. There have been GST rate cuts that have happened. So there are all positives also that have happened at the same point of time, other than basically tariff related issue solving, which I am sure would happen probably by March as well. Now, the key point to note over here is while all the problems started in March 2024, it eventually started to reflect in numbers only in December, and markets only peaked in September 2024. So while the problem started in March 2024, it got reflected or markets peaked out only in September 2024 because there is always a lag impact of everything that happens in the economy. So while the challenges started in March 2024, it started to reflect in the economy and numbers of the company only post Q2 numbers last year. Similarly, all the positive actions that have been taken in the last few years, last few quarters, will also have lag impact to eventually drill down into the economy and eventually also play out in the company's numbers, wherein the earnings will kind of improve from here on. So if you see incrementally numbers post Q3 and Q4 numbers last year, that is, I am sure when we all the investors had the maximum pain, right? Was the December quarter and the March quarter when markets peaked out and we had drawdowns, right? So, but post that, the incremental Q1 numbers were softer, but Q2 numbers were better than Q1. We believe that Q3 numbers this time around will be much better than Q2, and Q4 will be the one when, in our view, earnings upgrade cycle will also start from here on. Now, that is the time when basically, markets start discounting 1 year, 18 months forward numbers. So, in our view, the earnings downgrade cycle stopped in Q1. Earnings improvement has started to happen on expectations, or in lines with expectations in Q2. It will further improve in Q3. But really meaningful earnings upgrade because of all the positive things that we talked about will happen from Q4. And that is the time when markets will start discounting, 18 months forward earnings. In our view, FY27 should have earnings growth in the range anywhere between 15 to 18%, and markets will start discounting that very soon. So we are very constructive on the markets from here on. We believe we are in a very similar state as we were in FY22. I'm sure we all remember during Russia-Ukraine war, FY22, our portfolios again did not do much, and small and mid cap in particular had a very tough time in FY22. But then 23 and 24 followed up, which were very good years for the markets. We believe 26, 27 largely should be a repeat of what has happened basically in 23 and 24 post 22, which is very similar to what right now we are seeing in FY 2025. So very constructive on the markets from here on. There are a few challenges. Rupee obviously does not seem to be at. I'm sure all would be having questions on how do we look at rupee from here on, which is at 90, right? I think the answer to this question is very simple, right? Rupee at 90 was a pain point for India, right? When crude, was not at levels where it is right now because we've been big importer of crude, right? Now crude at the levels where they are, it doesn't impact the economy as much as it used to do earlier. That's the first important point to note. The second is also the current account levels where we are, the CAD that is where it is, right? Again, it's not much of an impact of rupee being where it is, right? Having said that, yes, there will be few companies which are basically importers, which will kind of get impacted in the short term. But historically, we have seen that eventually the markets realigns, and there is not much of impact only on account of rupee movement. We see that with exporters as well. While exporters tend to benefit a quarter or two, but eventually the buyers don't want you to make money on account of rupee imbalances, so the prices realign. Similarly for importers, eventually after a quarter or two, it kind of realigns. So that is our view on rupee as well. It doesn't seem to be a problem as of now because of the reserves that we have, because of the current account of deficit levels where we are, and also more particularly because of levels where crude is. And we see no reason why crude should go to historical levels of $100 plus or so, where we are. So Raj, I'll take a pause here. I've explained right how we look at companies, how we look at risk, and also the market outlook at a helicopter level. You're on mute, Raj.
So thanks so much, Kunal. Sorry about that. So let me, ask a few questions that I'm sure, during the discussion, a few more clarities will emerge. So, in your view, which structural shifts in India are still underappreciated by the markets, and what early indications do you generally track to identify when these shifts starts translating into earnings and upgrades?
Right. So I think there are many trends which are kind of still if I may call so, not yet. There's not much of conviction, if I may call so, by the market participants in our view. Right. One is for sure manufacturing. Uh, you would be very well aware that we were one of the first few ones to identify manufacturing as a trend way back in October 2020. we still believe, that pockets of manufacturing are really right just at the cusp, and they have done phenomenally well, but still there are many more legs to manufacturing. I'm sure we all would kind of recollect as to how dream run chemical companies had in the period of 2012 to 2020, when the likes of Aarti, Navin, Sudarshan, you name any company, and they went on to become 20x, 30x in a span of 7 to 8 years or 9 years, right? That was just because of one change in environmental regulation in China, right? We have already seen post 2020, yeah, right? Many companies in manufacturing getting benefited on account of either import substitution or export opportunity opening up for them, or a mix of both. And I mean, to name a few companies, Tube Investments, right? We have all seen how they have. I mean, the whole of the Murugappa group has been such a big a beneficiary of picking up manufacturing big time in India, right? I mean, we have had many such. I mean, Anup Engineering, Ratnamani Metals, right? They have all Tube Investments I just spoke about have been all beneficiaries of either import substitution or export opportunity opening up for them. So within manufacturing, CDMO space looks very interesting and still underappreciated in our view, right? Then there are a lot of auto anchors, right, which already have domestic market opportunity, but now also MNCs are setting up shops in India and thinking of India as a manufacturing hub for supplying goods to their counterparts across the globe. So that is again a opportunity which looks very interesting, and there's a lot happening out there, both on account of existing businesses that they do in India, plus export opportunity opening up for them. There are pockets of capital goods, right? I mean, we believe that the spending that is happening on the thermal power side, right, is still underappreciated. While there have been a lot of talk on the renewable side, but there is utter capacity shortage on the thermal power side, because yet storage of renewables is something which has not been
Yeah.
sorted out, right? So we are very
Yeah.
bullish on this space, and we have a few companies identified already way early, which have been like almost 2.5x, 3x for us. We still continue to hold, and we believe can double from here on as well, right, in this particular space. So again, that is something which kind of really looks very good from here on. There are companies in niche chemical space, as is niche chemical companies as well, right, which again are doing a lot of work on the import substitution side and are not dependent on export markets of US and UK, right? Again, that pockets in manufacturing seems to be looking interesting. Other than this, obviously, we are very convinced on banking to pick up from here on, because credit growth, which had kind of slowed down in the last 1 year. Now, with all the actions that have been taken and liquidity easing, credit growth picking up, and no real stress big time on the asset side, again, is something which will kind of do well from here on. So, I mean, to cut short your question, Raj, I mean, there are pockets of buys out there which really look very interesting. And as we discuss how we are placing our portfolios and positioning our portfolios and our top picks and holdings across both the strategies, I think yeah, all the participants will get more clarity.
Um, oh, that's very interesting. As someone who has researched sectors, as varied as banking to chemicals, what are the most reliable qualitative markers that you found that help distinguish a short-term cyclical uptick from a true long-term compounding story? If that could be very interesting to understand.
A very good question, Raj. And I'll be very frank and honest here, right? On day one, right, it's all about probabilities and risk reward, and then you build on it, right, as we kind of progress. So let me start with you as to how manufacturing clicked to us. So during COVID times, we were doing a lot of stress testing on our portfolio companies that we were already investors. right? And so the thing that you do when there is a lot of uncertainty is you try to get the guys who are running the show and understand from them actually what's happening in their business, right? So we started interacting with a lot of our portfolio companies from the point of view of stress testing, right? As to how worse things can become in your assessment, and how much dry powder are you keeping, because what is your strategy, because sales are not happening, people are not coming to the factories, so what's happening? And that point acted, as a source for us to boil down on manufacturing. We always had the history of what played out in chemical companies from 2012 to 2020, and in our interaction with all the companies, one thing was constant, that queries from global companies have kind of gone up because of COVID, because now people want to diversify their supply chain. It's no more only about government wanting to do something on manufacturing, because I'm sure you would all appreciate that government was trying to make it big in manufacturing from 2014. There were already a lot of tariff barriers, anti-tariff barriers, etc., being placed from 2014. But this time around, in our interactions with the managements and companies, we came to know that it's global companies who want to diversify their supply chain, don't want to have concentration risk, are evaluating us as their channel partners. They are okay even if we are not there yet on cost, which in many places we were already there, because China, Europe had already become expensive when it comes to a lot of power related cost or labor related cost. It was only scale related advantage that China had, which India never had, and which still continues in many spaces, right? While China has scale advantage, India has not that kind of a scale advantage, right? But other than that, barring that, there is hardly any difference in the cost, right? So then we built an hypothesis around that, and we were convinced that yes, this time around manufacturing will kind of play. And at the end of the day, we want a handful of 25, 30 companies, because while all the entrepreneurs will try, not everyone will for sure make it, but there will be some companies that will kind of make it. So you start with the top down view, and then eventually you boil down to the strength of the company and the view on the management, and build an hypothesis around it and stitch it. So that is how eventually it works, when you tailor, when you actually put all the pieces together and build an hypothesis and then place it brick by brick.
Fascinating. Any examples that you can give for the contrary, things where probably you looked at it and realized it's a shorter term cycle and probably not something that you want to add to your portfolios.
So I think chemical companies which have got a lot of business dependence on UK and US are something we always believe will because the balance sheets are very strong. Many companies have core competent advantages, right? Because the chemistries in which they are, right, they are like really the bellwethers out there. So core competence advantage, balance sheet very strong, capacities created, and every time you believe that demand will come back and they'll be able to fill their capacities, and something or the other happens, and the demand never kind of comes back, right? So I mean, this is the one latest example for the last 2 years, which I believe very well everyone will connect with, right?
Yeah, I completely agree. Okay, maybe let's move to the next question. It's like, how do you balance your conviction? I mean, what I mean is, what conditions make you increase position size aggressively, and what makes you deliberately keep a strong idea small? I mean, despite probably liking the business, you don't increase the weightage.
Right, right. Raj, so again, so let me take an example in our portfolio, right? And I'm sure everyone can see the major holdings in the fact sheet on the screen. Is it visible?
It's visible, and probably
Right,
my question
right.
is
So
specifically from that. You have 9% in Loris Lab, and you have probably 2.9 in Philip Carbon. So the idea was basically to
yes, yes.
understand.
So yes, so a very good question. It gives me an opportunity to discuss the portfolio as well, Raj. So I'll mix it up both, right? So let me take it up. As I said, that we are in the business of risk reward, right? So and our USP is the magic basket, which I talked about. It's like identifying strong companies which are lacking growth, right? And because of some change, either change in CEO or business strategy or industry cycle, right, etc. And we believe in that good, strong businesses which were lacking growth. Growth will come by, and value which is not yet deciphered by the market will actually kind of unlock, right? That is when you make money both on account of profit growth as well as multiple re-rating, right? And that is also one of the reasons of our alpha generation across all our strategies, and in shift as well. That is only one of the reasons. So Loris, is an example. 18 months back. So just to give you a brief explanation on Loris, what does Loris does, right? So Loris is essentially a CDMO pharma player now, right? All the while, the company was into ARV formulations and drugs, right? Founded by first generation entrepreneur Dr. Chava. During COVID, they had one intermediary named Paxlovid, right, which they were supplying to Pfizer, and that opportunity, helped them make almost around 1,000 to 1,200 crore in a span of 18 months on account of only one intermediary, right? That cash flow and that opportunity did two things for the company. It was able to display their capability to manufacture something at scale in record time and at record cost to the big pharma companies in US like Pfizer. Now, before that, all the while, company was only into formulations and ARV business. This business displayed their capability of all the things that I talked about. But as COVID started to wane, right, the Paxlovid volume started to drop, the revenue started to drop, and the profitability went for a toss. But with this cash flows, company had made investments to make it big on the CDMO side, which is a much better quality business, a much better margin business, and more sticky business than the erstwhile ARV business that it was doing, right? So when we betted this on this stock around 350, 360 levels, and we had an history of Loris during COVID time, right? Because we had seen their journey from 2019 to 2021 and were aware of Paxlovid and all of that, right? So we had an history with them. So it was a classic magic case for us where a company with a strong capability displayed, strong balance sheet also to an extent at that point of time, because the cash that they generated was used to create capacities for the CDMO, and earnings were at the bottom. Earnings were at the bottom, and so was the share price. Right, it was around 300 and 350. We were very convinced that with the capability that they've displayed and the capex that they have done, incrementally in the next 18 months, they should get business on the CDMO side from the big pharma companies. And we took a very big bet of around starting at around 4 5%. We have reduced the allocation now. Obviously, we still continue to have it over, but we've reduced the allocation. We started with almost like 6 7% kind of allocation at that point of time across all our clients, right? Because risk reward was like we don't see much of downside. There could be opportunity cost because if the business doesn't come by, it may take a little longer, but eventually it should come, right? So you could have opportunity cost, but downside was limited, and that is what made us to take a bold call and a very high conviction call. Now, if you see, Biocon again is one of our top holdings, right? Right now, this is a very new entry or new company that we have bought just about a month back or so. Again, similar kind of scenario. Biocon started by first generation entrepreneur Kiran Shaw. Very strong businesses created over the years. They have own a subsidiary. Sorry for this long elaborated answer, but I
No, no, this is most helpful. I mean, I think it also gives our viewers an understanding into the thought process.
right. So again, a business started by a first generation entrepreneur, very strong businesses in the form of Syngene. Biocon is into formulations, and the company that they acquired in 2017, which was Biocon Biologics. So strong underlying businesses. But in 2017, when they acquired Biocon Biologics, the business was acquired on the back of debt, It was a very big acquisition. Consolidation did not happen in the way expected for almost like 5 6 years. And now we believe there are like 3 4 changes that have happened other than the moat that it has in the form of a very strong first generation entrepreneur and very strong underlying businesses, right? 4 changes have happened are right. They raised money to the tune of 4,500 crores at around 330 rupees from good institutional investors, giving them long-term capital, which has helped them reduce their debt and bring balance sheet at the consolidation level to a manageable levels. The second change that has happened is they've brought in Kedar as the CFO. Again, we have had an history with Kedar because the same kind of issues Cipla was going through back then in 2019, right, where they had done a lot of acquisitions and they were trying to get back the return on capital employed and improve the balance sheet, where Kedar and Umang Bora played a very big role. So Kedar we had an history with, and Kedar joined them as a CFO to manage all of their financials. Third thing was Biocon Biologics now, after so many years, in our view, has consolidated and will report growth in FY 26 and 27 because of the biologics that have been launched or are there in the pipeline for the next 2 years. Will have growth after so many years in the biologics business, right? And Syngene is a world-class asset that has been created in the CDMO space, which will keep compounding as we kind of move along. And Biocon formulations never had big problems that time, right? Along with that, Kiran is now hands-on. She was a little away for the last 5 years, and there was a professional management team at place. Now she is hands-on. She is actively involved in the business, right? So all of this four, and there's a lot of valuation gap, right, between the other big pharma companies and Biocon Biologics, right? So our view is that heads, if we win, we'll make it big money if our investment hypothesis plays out. Tails will not lose much, right? If our investment hypothesis did not play out because we are not paying up, right? So that makes sense or gives us the conviction to start with a high allocation, right? So that is how it is. And then once the magic is kind of played out, right, it becomes a compounder for us, right? And then we take a call as to in compounder, how does A pairs between B, and if we like one over the other, we either sell the stock or reduce the allocation. So PCBL was a magic for us, right? It's now played out its re-rating, so it's become a compounder for us, and therefore that small allocation.
Well, this gives us so much insight, in terms of the thought process which goes into why a 9% and why a 2.9%. And one of the reason for the question was exactly that. Thank you so much, Kunal. Probably the
Just
next
two things, if
question.
I may add more, Raj, on this,
Yes, please,
right?
please.
So again, Kalpataru is something which our mind is again a non-consensus, non-differentiated, non-talked, under-owned idea. Again, a very superb. I mean, we all have heard of Kalpataru, right? A very strong, it's like they were a legacy of 50 plus years in the business, right? We are very bullish, as I said, on the power generation and power transmission and distribution side when it comes to India and globally as well. So again, a perfect recipe for a magic idea where valuations to start with, yet not deciphering the change, super strong management with hands-on experience on the business that they are, right, and visibility of earnings because of the order book that they have for the next 2 3 years, right? I mean, in a mid-cap company, if you get this kind of a setup, right, you would want to bet because eventually it's a mix of concentration and diversification both that will kind of make money for you, right? So at all point of times, you will find around 15 stocks, right? Top 15 stocks having around 65 to 70% of the portfolio concentration out there. And, then there would be obviously the other stocks as well.
Thanks, Kunal. Okay. Here was another question. So, across your research career, what has proven to be most credible signal that a company is entering an inflection point? Is it operational signals? Is it cultural? or is it a financial signal? So before the broader market identifies it, what is the signal that is most credible?
So Raj, I think culture of a company does not change overnight, right? So culture, either it's there or it's not there, and if it's not there, it like really takes very long to change the culture of the company, right? So first, it's the intent and realization, right, by the management that something is not working out, right? While we are all very strong and business is strong, but if growth is not there, right? So in case of AB Capital, right, it's a Kumaramangalam Birla Group company, right? Cost of funds, which is most important when it comes to lending business, right? In lending business, what you want is cost of funds because that determines the kind of quality of customers eventually that you would lend to, which will eventually determine like what kind of NPAs and pricing and everything would happen, right? So they always had this advantage of cost of funds, access to funds because of it being a part of Kumaramangalam Birla Group. But what was lacking was growth, right? And then there was a CEO change and all the actions, right? So that's the starting point, right? Realization, and then taking all the actions, to kind of, reflect on whatever needs to be done. And then basically the assessment that you have to take is whether they'll be able to deliver or not, right? And that's basically where due diligence help in. So we meet, then we meet the new CEO, we meet the people down them to understand how is the acceptability, what are the things that they are doing will actually fill the gap which was not there earlier or not. Speak to their channel partners, speak to their distributors, speak to their suppliers, speak to their bankers, if possible, speak to their auditors. So that's on the connect side, right? Because at the end of the day, everyone is seeing the same numbers as you are seeing, right? So connect framework also helps a lot. And then basically you take a 360-degree view. So I think to specifically your question, first is the realization and then the actions that they take, right, gives us a good lead indicator. I mean, there have been instances where we have betted on similar kind of instances, but or businesses, but they have not worked out as we would have wanted them to work out. And I can share those examples as well.
Thanks, Kunal. Yeah, I have a couple more questions which has come in, and we have 15 more minutes. I just want to maximize the time that is there. Given the premium valuation in several quality and growth pockets today, how do you differentiate between expensive but justified versus expensive and fragile? What frameworks do you rely on in these to differentiate these categories?
Yeah, again, a very good question, right? So it's always that said that value lies in the eyes of the beholder, right? So say again, see, it's more to do with see. Therefore, they say valuation is an art and science both, right? So to be very frank, there is not a straight answer when it comes to valuation, right? So everyone has their own framework, right? So we have our own framework, right, as to how we see at valuation, right? So there are multiple parameters, right? First, obviously, we do the assessment on, the growth, the quality of the management, how the earnings can kind of play out, the quality of earnings and everything. And then generally PEG or, reverse DCF has given us a fair idea as to where we are in the valuation band when it comes to companies or markets, right? So, and I mean, at the end of the day, we want 25 to 30 companies to kind of invest in. At all point of times in the markets, there are pockets where there is excessive, right? I mean, defense, EMS companies, etc. Right? About 2 years back, all the new age companies had a lot of excesses, right? And then it corrected its way course, and then it became interesting. I mean, we betted on Paytm, right? Again, a magic basket for us at around 600 kind of levels, right? And again, I mean, there was excess at one point of time, and then there was absolute disregard to the change that was happening in the business and the valuation, right? So I mean, to obviously we are not in the same point of time as we were in 2020, right, where we were like really very, very cheap. But having said that, we believe that to make 18-20% kind of returns in mid and small cap fund from year on in a 3 to 5 year view is a reasonable ask. And at the same time, in flexi cap strategies with biasness towards large cap, expecting around 12 to 15% kind of a CAGR, right, again is a reasonable kind of expectation over here from 3 to 5 years point of view. So for sure, we're not at the times where we were in 2020 for sure. But at the same time, there are pockets where there is valuation in relation to the growth they provide as well, comfort.
Um, if you were to define the next decade of compounding in India with just two themes, what would they be, and what risk could derail them that investors are not discussing enough?
I think manufacturing and banking, right, are something which will kind of are the themes which we believe will like really make it big. Banking, obviously, because it's very large to create large franchises, right? Because getting deposits is like really next to impossible. While consumption, is going to, but the way India consumes and what India consumes is changing dramatically, right? So I think banking and manufacturing is something which will like really drive the next decade or so.
Thanks so much. Uh, Most managers talk about risk as volatility, but Carnelian talks a lot about risk of capital impairment. So, what are the top two, three red flags that immediately reduce your willingness to stay invested, irrespective of valuations?
Right. So again, a very good question, Raj. And as I said, that we have a clear and connect framework, right? So for every company, before we start to do deep dive, we just run an automated template, put the ticker of the company, and we get on the screen a lot of parameters highlighted into green and red. Where red, even for a associate, it will be like an eye opener where he will have to kind of look into why is the reason that this is popping up as red, and these are all very simple parameters, right? I mean, tax paid as per cash flow is not watching matching with tax as per PNL. Tax rates are 25%, but the tax rate otherwise is coming. These are not like sacrosanct. There could be reasons for it, but at least it's an eye opener, right? So tax rates, interest rates, generally, I mean, it's 10-12% for any company. It's either 17%, 18%, right? But debt is not there, or debt is very minimal in the books, right? It could be on account of off balance sheet items which are not reported as debt, right? So capital saved is capital earned, right? So there are a lot of red flags. I mean, I can speak like too many. I mean, I can just go on speaking about many parameters out there. It could be, I mean, there is cash flow analysis, right? I mean, cash flow from operations can be, there could be multiple reasons out there where there could be asset analysis, right? I mean, you have fixed assets in the balance sheet, but you don't have insurance as an expenditure, right? uh, uh, Again, net worth accretion, right? Your net worth is changing, right, but it's not moving in lines with PNL. Then again, there are a lot of adjustments which require actually PNL adjustments, but are just been routed through balance sheet, right? So again, that's a red flag, right? Contingent liability as a percentage of net worth, again, right? I mean, off balance sheet, what's the risk that the company is taking, right? Because not many would try to dig deep into contingent liabilities, but just in case if it crystallizes, again, it's like a big risk, right? So I mean, there are multiple instances.
No, I think you've covered quite a few of them. Very interesting, some of the points that you highlighted. Probably my last question is slightly behavioral. Uh, what behavioral biases have you seen most commonly affect fund managers, including experienced one? And what personal systems or routines that you've put in place to help you stay objective across market cycles?
I think I talked about type C risk, right? So, and having a robust team, helps you keep steadfast. But I think recency bias at times plays into everyone, right? And also our old biasness and our views on a particular company. I just gave an example, right? If somebody would have been an investor for SDFC Bank in the last 5 years versus somebody who would have been an investor in ICICI Bank, right, would have completely different examples as to how banking in India has done in the last 5 years, right? Now, I mean, there's nothing wrong with either of the franchises, right? It's just that at that point of time, right, one was going through a magic event and the other was, having a very large shoes to kind of fill in, right, and probably a derating candidate, right? Uh, our old biasness would have not helped us changed view on a particular bank versus the other view. ICICI Bank recency bias, because of all the issues it was facing, would have been on the negative side, and SDFC Bank on the positive side. But eventually, how it played out was opposite, right? So, uh, I mean, recency bias, I would say.
Was fantastic. There's a couple of questions on the chat box. One of the question is you've recently added Man Industries and Garware High Tech. What's the thought behind it? What's the rationale?
Right. So I think both the companies basically are going to be a beneficiary of import substitution and export opportunity, right? So Garware is an addition on account of export opportunity opening up for them in the US market. They are presently facing issues because there's been a lot of talks about it business getting impacted on account of tariffs. But in our view, business is not going to get materially impacted because of this. Even if it gets impacted, it'll be like a quarter or two kind of a scenario, and risk reward, is kind of really interesting for us, and therefore the bet out there on Gerware and Men is on account of again export opportunity opening up in Middle East, right, which was earlier occupied by a lot of players in China. Right, and there is a large capex which is coming on stream for them, so there could be earnings growth on account of the export opportunity coupled with capex coming on stream at that point of time, and valuation comfort as well. So if earnings do accelerate in our view, then there could be multiple re-rating as well. So it's a perfect play. Both the companies are actually a play of manufacturing. One having import substitution. Just give me a second. Yeah, and the other one an export play.
No, take maybe a sip of water, Kunal. You've been
I'm
speaking
all good. Yeah.
non-stop. Uh, Kunal, probably there's one more question on the chat box which says if someone has a lump sum to invest and looking to invest at current market condition and the outlook ahead, would you suggest a lump sum investment or a staggered investment over a 6 month or a 12-month kind of period?
See, if you ask us, we believe this is a very right time to kind of invest with a 3 to 5 year view. Right. So, any which ways to our mind is good. And basically, any which ways as a fund house, whenever we get the money, also, we take our own time to kind of deploy as well if we are not too convinced on the markets. We obviously don't take cash calls because we start with the basic premise that cash call has been taken by the client and is giving us money to deploy in equity markets. So we don't take cash calls, but at times if required we do take time to deploy money, which can range anywhere in the range of 15 to 20 days as well.
Right. Don't see any other questions on the
Great.
chat box, and we are bang on time, Kunal. So, thank you so much for taking time out today and being very candid and expressing your thoughts, views, and giving us a detailed insight on the portfolio. And I'm sure all our clients, viewers would have, seriously enjoyed the interaction.
All right.
As I am about to end, there's one more question from one of our panelists. It says, please advise about BEL share. Uh,
Well, we don't own it, right, but they have been doing decent work on the defense side that is opening up. We don't own that stock, so with that caveat.
You also don't have any defense play, Kunal. Any specific reason?
It's not like the defense opportunity is not real, but then the valuations actually, to our mind, right? Discount a lot of the earnings already, which will come in the next 3 years, and that's the only reason why we are not owning any defense stock.
Okay, and
But having said that, we keep evaluating, and if we believe at any point of time, right, that we have something in place which offers a very good risk reward play, or which is a magic event for us, right? I mean, we can look. We never say never, right? So.
your views on solar and renewable energy?
Well, again, see a lot of solar companies basically out there. I mean, EPC companies are facing a lot of challenges out there. The non-integrated ones, right, will probably face challenges because they are not integrated, and there is excess capacity also, to our mind, built up out there, looking for business out there, which makes it further difficult for the margins to kind of sustain, right? So as of now, we have avoided both the space of solar and renewable.
I don't see any questions, and we've actually run out of time today. Maybe we'll get Kunal again, if maybe with some changes at some other point, maybe in the next quarter or something. But Kunal, thank you so much for taking time out and sharing all your views and thoughts. And thank you everyone who's joined us today. Good to have you, and we are looking forward to have all of you participate in our next webinar. Thank you so much,
Thank
everyone.
you.
Thanks,
Thank you,
Kunal.
everyone. Thank you so much. And Raj, you've been a wonderful host. And thank you, everyone, for being out here. We write our letter to investors every month. Right. We just written a letter on our magic framework, where we have further delved into how we think about different companies and this framework. Please feel free to read it. And we also every quarterly do a quarterly connect with our client partners and our clients. So please feel free to join us over there as well. Thank you so much.
It'll be a pleasure.
Have a
Thanks.
great
Thanks,
have a
Kunal. Thank you
great
so
weekend,
much.
guys. Thank you.
Thank you. Thank you so much, everyone. Thank you for
Thank you.
joining us.